See, when we look at the various applications of financial statement analysis, the two key areas which we always talk about, they are either used in credit appraisals and credit analysis, mostly used by banks and all these kind of companies, or probably they are used heavily in equity analysis and valuations. Two major areas. But most of these, in both these analysis, what we typically use is we do calculations on the historical data, ratios, or probably looking at the increase from year to year or common size or whatever is the analysis we are doing. We are not doing on the future, we are doing on the historical data, but use that historical data, right? We do some kind of calculations on income statement, balance sheet over the last few years of the company as well as industry as well as competitors. We do all these kind of things. The reason being, using the historical numbers, we try to forecast the future. Okay, at what rate the sales of this company have been growing over the last 5 years. Based on that, I will assess at what rate they will grow next year. These are the various inputs, and probably, okay, the cost of goods sold around 70% of the revenues every year. So probably next year also, I can assume that the company's cost of goods sold will be around 70% of the revenue. So to address these kind of things, what generally the financial analysts do is first compare the various ratios and various calculations on the historical data. Because today, if I have to invest, right, or if I have to give a loan, I should be least bothered about the past. How much profitable the company will be in the future is what is my major objective. But I am still looking at the past financial statements, because using them, I want to create the future financial statements, whether it is in a credit analysis or in an equity analysis. The major thing that happens is using the past financial statements, using various calculations on the past financial statement, people try to create futuristic financial statements. And based on the futuristic financial statement, they get into the either the credit analysis part or the equity analysis part. So they establish some kind of trends based on various ratios, all efficiency or profitability, various ratios. The intention is to understand the pattern. Okay, is it more stable? Is this ratio more stable? Or is it more growing? Is it more falling? Or what is the industry average for this? What is the based on that, they want to come out with some number for the next year or for the next few years. So all the ratios are typically computed for the simple reason to understand the trend over the past few years, so that they can give one number for the future. And based on that, they want to prepare a future P&L statement, future balance sheet, and future cash flow statement. That is what is the root for valuation. Right? Finance always believes in is always based on future, not the past. But we are doing the past analysis so that we can put better numbers for the future. So we are trying to make some kind of trends, right, based on which I can compare them with the past of the company as well as with the competitors as well as with the industry average, to really understand what numbers I should put for the future. This will help me in understanding the business strategy of the company. Are they spending more on advertising, or are they spending more on employees? Because once I understand the various costs, I can understand the business strategy of the company. And in any typical kind of forecasting mechanism, first we will forecast the sales growth. There are various mechanisms which will be applicable to forecast the sales growth. Either I can simply use last 5 years on an average they have grown at 10%. So next few years also assume the growth to be around 10%. That's a very simple kind of stuff. Otherwise, people get into linking it with respect to economy. Okay, when the GDP growth was around 8%, this company growed around 15%. So probably next year the GDP growth is only forecasted at 6%. So probably this company will grow only at 12% or 13%. Something like that is a slightly more advanced way of predicting your sales growth. But once the sales growth is predicted using your common size and various ratios which link the sales, there are so many ratios that link up the sales. We have so many profitability margin, net profit margin, gross profit margin, or probably turnover ratios, asset turnover. They are all having sales as one of the element. So what I'll do, I'll compare those ratios and I'll put some number for the future for those ratios. And now I have forecasted the sales. I have a new number for this. I can forecast the other value. See, it's like this. Okay, the sales of the company, let's say this year are 10,000, right? So, okay, I have been observing for the last 5 years that on an average the sales is growing at 10%. So what I'll say as a part of my future financial statement, I'll say the sales will be 11,000. Okay, and I am observing, let's say the asset turnover ratio, total asset turnover ratio, I am observing for last 5 years. Okay, here it was 1, 1.1, 1.2, 1.3, 1 point, something like that is coming out. Let's say some pattern like this is coming out. What I'll say, oh, next year they have been growing slightly better here. So let me say for next year, let the asset turnover ratio be 1.5. Just, I mean, observing the trend in the past, I'm trying to put one number for the future. Because these are estimates. I'm making some kind of an estimate. Saying, okay, let me put asset turnover ratio as 1.5 for the next year. What is asset turnover now? Sales by total assets. That is the asset turnover. So for the next period, I am putting it as 1.5. Sales is 11,000. 11,000 by total assets is equal to 1.5. So from here, I can find out the total assets. So this is how I am putting the number for total assets in the balance sheet for the next year. Similarly, okay, the gross profit margin, right? Probably I am observing, okay, 20%, 21%, 20.5%, 22%, 21%, something like this over the last 5 years. Then probably what I can say, oh, they are somewhere around this 20-22 range. So probably let me take it as 21%, probably the average of the last 5 years or something. Let me take it as 21%. So obviously for the next year, 21% of the sales. So sales is 11,000. So I'll take 21% of 11,000, whatever it is, right? 21% of 11,000. So probably I'll say 23,100 or 2,310 is my gross profit. So what is happening because of this analysis? Every ratio, the moment I am understanding their patterns, and based on the pattern, I give some number for the future and use that to prepare a future financial statement, both cash flows, P&Ls and balance sheet. And that is what is the base. Oh, in future, this company can generate this much of profit. In future, this company can generate this much of cash flows. In future, the free cash flows of the company are going to be this much. Based on that, we'll talk about the valuation of the company. So any valuation which is being done is not on the historical data at all. The historical data is used to prepare the future financial statements, and based on the future financial statements only, whether it is the credit analysts or equity analysts, they work only on the future financial statements to predict the price, to predict the loan payment capability of the company, whatever it is. valuations, they work only on the future data, not on the historical. But to prepare a future, they need a base, and that base is historical. So the more and more ratios you analyze, the more and more good patterns can be understood on the data, so that a better financial statements can be projected for the future, resulting in a better valuation of the company. So that's where I say, whenever we are talking about a credit analyst, the intention is finally to look at what is the operational efficiency of the company, right? Because the typical ratio EBIT by I, which is an interest coverage ratio, which is a very heavily looked at ratio by the credit analyst. Where is this EBIT coming up? Operations, right? Operating profit kind of stuff. So typically, how good are the operations? So if the efficiency ratios are increasing, probably credit analysts give a better credit rating to the company. So basically what we are saying is the various ratios, right? How is the stability? Profit stability, how much is there for the company? Gross profit margin, 1 year 40%, the other year 15%, the other year 70%. It's a very risky kind of a company, right? Even the net profit, right? How consistent they are, right? Otherwise, okay, we don't know next year, is it going to go up or go down? Some years sudden increase, some years sudden decrease. The risk is actually growing up. So typical analysis should happen in terms of consistency, in terms of various margin kind of ratios, profitability kind of ratios. What is the kind of consistency that is existing, and to what extent the solvency of the company is there, because that is what is the leverage kind of ratios they measure. Okay, if the company is already taken a huge loan, probably there is a possibility that in the next few years they have to borrow something more also, which is an indication of a risky nature about the company. So the credit analysts look at all these things, whereas equity analysts, okay, they prepare a kind of a framework. Let me look at some 10-20 ratios. Using them, let me forecast the future financial statements. And probably they may even create a kind of a model saying I'll give more weightage to XYZ ratios compared to ABC ratios. So each analyst will differ in his own interpretation aspect on how much weightage he has to give, how many ratios he has to consider, because all those things, because they are more of estimates, they differ from analyst to analyst completely. It's not a mathematics where you have to take 1, 2, 3, 4, 5. The more and more you can go deeper into the financial statements, create more and more ratios, analyze the patterns between the ratios, and you see which of them are more critical compared to the other. And that is what will differentiate an analyst 1 from analyst 2. And sometimes the analyst also may have to make some kind of adjustments, because when two different companies are presenting the financial statements under two different standards, one is using LIFO, the other is using FIFO. This is the major task for a financial analyst. Not just looking at the template of numbers. Are there any kind of manipulations, or are there any kind of significant differences in the methods that the companies are using for reporting their financial statements? One is following LIFO, the other is following FIFO, or one is following US GAAP, the other is following IFRS. Because as an analyst, what is required for me is come out with a clear-cut comparison between the two companies. Right? If one company is following a GAAP and showing a higher cash flow from operations, whereas the other company is following IFRS and showing a lower cash flow from operations, I have an issue. Right? So these kind of things, the analyst should be comfortable from changing one form to the other, and then try to evaluate the financial statements of two different companies. So that is the major role for an analyst. If he had to come out with a better evaluation of the company using the financial statements. I mean, if only if those adjustments can be made comfortably, whatever the analysis that the analyst is coming out with has a more of real significance in the real world.